Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research at the University of Buckingham. It's June 2021, and I'm going to be talking in this presentation about inflation prospects, and particularly how inflation is affected by the quantity of money and its rate of growth. And it'll be dealing with the leading economies, but with a focus on the United States. A year ago, we had a start of a debate on this subject, with the standard view being that the COVID-19 pandemic meant that there are going to be job losses and bankruptcies, and so there'd be disinflation, reductions in inflation extending over some years. And this view was expressed, for example, in the June minutes of the June meeting of the Federal Open Market Committee, that is the key policy-making committee of the Federal Reserve, the American Central Bank. The alternative view was that the then rather clear and rather dramatic acceleration in the growth of the quantity of money in the USA and elsewhere would mean that the sequel to the pandemic would be an inflationary boom. And this is a view that was expressed in the research from the Institute in a number of videos starting in March last year and continuing to the present. And this is in June last year, I brought attention to the perspective, the analysis implied by the quantity theory of money. Now, this had in fact been preceded by an email from me in early April, which I'm going to quote, and I think it's quite important in terms of understanding what's driving inflation to look at this. I said there that the acceleration in money growth would lead to, rather like after wars, an inflationary boom. And as far as the United States was concerned, where money growth reached 26% in the year to June 2020, I said it seems to me that a major increase in inflation due to the boom is inevitable. Whether the increase is to 5% or 10%, no one knows for certain yet. Well, in the year to May 2021, just come out this month, the increase in the American Consumer Price Index was in fact 5.0%, 5%. So this sort of conjecture I made about a year ago has been correct. And the debate now is not about inflation against disinflation, it's about whether the current upturn in inflation is transitory or is going to persist. And that's really what I want to focus on today. Now, once again, the dominant view, the consensus view, is complacent. And we had a contribution from Paul Krugman in his New York Times column a few days ago, 21st of June, in which he said that those who are talking in terms of an inflation panic, well, you know, they're so last week. Seriously, this is again to quote from Krugman, both recent data and recent statements from the Federal Reserve have, well, deflated the case for a sustained outbreak of inflation. So I assume from this that Paul Krugman endorses the current view held by the Federal Reserve about American inflation prospects. Now again, there was June 2021, another meeting of the Federal Open Market Committee. We don't as yet have the minutes, but we do have some notes released with the press release, the press conference and so on, just after that meeting. And according to the combined wisdom of the FOMC, the inflation rate in the year to the fourth quarter of 2021 will be in a band of 3.1 to 3.5% US consumer inflation, so in the middle 3.3%. And I assume that's also Krugman's position, more or less. I'm going to pick that up at the end of this video, but now I want to provide you with what I regard as serious analysis. I don't know what Krugman's view is, but I regard serious analysis. I'm not talking about weeks, I'm really talking about years. And I'm going to start with the United States. Now, if you believe in the quantity theory of money, then you would say that the equilibrium level of national income, the level towards which all the forces in the economy will drive national income, will be equal to the quantity of money multiplied by the velocity of circulation. And the velocity of circulation itself depends on how much money people want to hold relative to their incomes and transactions. Equilibrium national income depends on the quantity of money and the desired ratio of money to income. It's almost a tautology, really, but it is making a statement because it's saying that, you know, there may be some disturbance of equilibrium because of wild fluctuations in the rate of growth of the quantity of money. We can see the figures for the velocity of circulation of broad money in the United States in recent years. Obviously, we don't yet have figures for most of 2021. And there's this obvious point that in 2020, there was this money growth, rapid money growth. People couldn't spend it because of the pandemic. So the velocity of circulation fell. But in 2020, that was a departure from normal experience, and kind of normal experience is more represented by the value of velocity in 2018 and 2019, when the figures were typically a bit over 1. And then we have this chart showing the explosion in money growth last spring, the annual rate of increase peaking at 26% and still at the moment in double digits. What I've done to get a sense of where national income will be moving between now and the end of next year is to multiply a figure which is 5% less than the average velocity in 2018 and 2019. So it's a return to normal, but not a full return to normal. Multiplied that by what one might reasonably project the quantity of money to be at the end of next year. The recent growth rate of money in the USA has been around about, since the start of 2021, around about 10-11%, annualizing the figures in that period. But I'm going to take it that in fact the number is going to come down to 5%. So I'm assuming from here 5% growth of money, and I'm assuming that velocity returns to normal, but not fully, by the end of next year. What does that mean for equilibrium national income in the fourth quarter of 2022 compared with the first quarter of 2021? The answer is that equilibrium national income at the end of next year is 30% higher than in the first quarter of this year. Now that 30% increase is going to be split, if that's what happens, it's going to be split between the increase in output and the increase in prices. One can debate whether there's plenty of spare capacity in the American economy at present. Most business surveys are indicating shortages of labour and serious production bottlenecks in some sectors. So I would argue that there isn't much spare capacity, and that kind of the maximum amount of output increase between now and the end of next year is, say, 8%. At the extreme, say 10%. What does that then mean about the price level? The price level would be rising by 20% or so. Well, look, I don't know exactly what's going to happen. What I'm putting to you is that this is a serious line of work, to use this word serious that Professor Congdon wants to use, and it implies at least that inflation between now and the end of next year is going to be running in a 5% to 10% band. Okay, that's the United States. What about the Eurozone? Well, here I'm just going to use the same kind of analytical approach. And let's have a look here at the behavior of the velocity of circulation of broad money in the last decade. And you can see it's been relatively stable, going gently downwards, relatively stable, until we get to last year, when it plunged. And plunged for the same reason as elsewhere. Jump in money growth, but people couldn't spend the money because of the pandemic. So what I'm expecting for the next 18 months or so is that the velocity of circulation will return towards the equilibrium figure. But again, in order not to bias my answer, I'm going to take it that we'll be a little bit, by the end of next year, 5% lower than the average value in 2018 and 2019. And again, I'm going to assume roughly 5% a year growth of money between now and the end of 2022. What does that then mean for equilibrium national income at the end of next year? The answer is it should be about 25% higher. Look, again, I don't know exactly what's going to happen, but I'd say at the very least that a forecast of inflation over 5% is justified by the acceleration in money growth we saw last year and the fact, which simply cannot be escaped, that the trend rate of output growth in the Eurozone is not much more than 1% a year. So if you have money growth running the double digits, it's not that surprising if one comes up with a forecast at some point of inflation of over 5%. Let me now conclude this discussion of where inflation is going in some countries with the UK. Here again, there's a chart of the growth of the chart of the velocity of circulation in the last decade. You can see that it's very, very stable. In fact, the figure at the end of 2019, before COVID, just before COVID, was the same as in the first quarter of 2009, over 10 years earlier. One or two ups and downs in between, but really very stable. And the average level of velocity in that period, compare money with the annual GDP figure, was just over 1. And very similar to the United States, not that different from the Eurozone, in fact. And you see again at the end, the COVID period, velocity collapsing. So let's again assume a return to velocity 5% less than the average of 2018 and 2019, and 5% money growth from here at an annual rate. And the answer is, again, we get a figure for equilibrium national income at the end of next year of 25% higher than in the first quarter of 2021. And again, my conclusion is that to say that inflation will exceed 5% isn't really particularly surprising given the analysis, the context, the theories that I've been developing and describing. When one reaches conclusions like this, one always wants to cross-check. And so what I tend to do is to look at business surveys to see what's actually happening on the ground. And what I've done here is to condense in one picture the results of the latest purchasing managers indices for manufacturing in the United States, the Eurozone, Japan, and the UK. And what I want you to notice is that in every case, it's moving upwards. So the last value is for May. The first value is for October last year. The last value is for May. The boom is gathering pace. It's intensifying in these 4 countries. Now, the 4 countries represent over half of world output. I haven't included China, where things are a bit different. But on the basis of this, the analysis, the message of rising inflation is reinforced. Okay, I've set out the reasons for believing that inflation in the United States in the next 2 years will typically be in a 5 to 10% band. I've set out the reasons for believing that inflation in the Eurozone and the UK will exceed 5%, By the way, Japan, I expect they'll go through their 2% target. They've had a 2% target for many years. They'll go through that. But one then kind of wonders, well, why is it that I think I've given you some quite good reasons for believing that? So why does Professor Krugman, why does the Federal Reserve, why are all these other people, why have they got a different view? Well, sometimes in giving these videos, I want to scream. Let's just have a look again at that forecast from the FOMC prepared just a few weeks ago. They're expecting the increase in consumer prices in the USA to the fourth quarter of 2021 to be between 3.1 and 3.5%, 3.3% in the middle. You can very easily get the download from the internet. You can download the press release from the Bureau of Labour Statistics on the 5% inflation rate in the year to May. What that press release shows is that the increase in the consumer price index was between December 2020 and May 2021, a 5-month period. In that 5-month period, first 5 months of 2021, the increase in the CPI was 3.3%. Now, there is a seasonally adjusted and unadjusted index. The seasonally adjusted is a little bit lower. But effectively, what the Federal Reserve is saying, and the FOMC is saying, is that there will be no further increases in the consumer price index in the USA from May 2021 to December 2021, even though the business surveys are reporting an intensifying boom. What on earth is going on? Look, let's get some sensible comments here, some serious comments if I use that word again. The average increase in the CPI in the first 5 months of 2021 has been 0.65%. That's half that. Let's say it's going to be a bit over 0.3% a month, and there are 7 months to go. Then obviously that's 2.1 or 2.2%, which gives you a figure for the inflation rate at the end of 2021 of about 5.5%. I think, given the intensity of the current boom, to expect a reduction in the monthly figure of as much as that, as halving it, is a bit too much. You might expect the monthly numbers to come down a bit, but let's say it's 0.4% instead, then obviously it's 0.4 multiplied by 7, which is 2.8, plus 3.3, which is 6%. My conclusion is that inflation at the end of 2021 will be certainly over 5% in the USA, will probably be over 6%, and it could exceed 7%. And I look forward to continuing this debate with the Federal Reserve and Professor Krugman. Sometimes these things are just unbelievable. I cannot understand how alleged authorities, Nobel laureates and the like, could come up with conclusions that are so obviously untenable. Thank you.